Today, it's another edition of the Theo Night video for, what is it, Monday, December 5th, 2022? I'm like, my goodness, are we getting this close to the end of 2022, which for the most part has not been a great year for the market. So the question is, did Santa come early, and is it risk on or risk off into 2023? As you look at the October low here, we ran to the November high here. I'm looking at the wrong stock, by the way. Let's quickly try to... I threw it in there, but it did not take. The ES does not look much different here. But as you look at the run here from the October low to the November highs here, are we slated to have a rather disappointing December? Is it risk on or risk off into 2023? I will suggest there is a middle route. The middle route is we stay north of 3,900 and just grind it out. And then we'll see if there's a Santa Claus rally between Christmas and New Year's. But right now, today, with the decline in the S&P about 1.79%, we certainly are poised to have a rather disappointing December. And the spoiler in this is, of course, the U.S. dollar. If you look at UP as a proxy for the dollar index stronger today for all intents and purposes. The biggest component of that index is, of course, the euro/US dollar, which, again, was higher than faded, dollar strengthening. The Aussie/US dollar was rather weak, which is kind of a proxy for China, emerging market currencies, etc. As you look at a sector that I was rather bullish on last week, and we have this $28 to $30 target range that we talked about in my Tuesday session. Again, we're fading just a little bit today. So there is risk here for the market if the dollar continues to strengthen. And of course, that'll be felt on a more exaggerated level in emerging markets, like, for example, EEM, which has a lot of Chinese stocks that are represented in there. EWZ looked like it was poised last week to make a big move. Didn't. One of the stocks I was keying off on Tuesday was Vale. It eked out some further gains, but it's coming in a bit today. So the risk for the S&P is, of course, the dollar strengthening. And where do you see that represented more than in the price of gold? And we'll use the ETF GLD as a proxy, down 1.7% today. Well, if you look at the S&P, it was also down 1.7% today. We could argue that all of the downside today in the S&P 500 could be attributed to dollar strength. So if that dollar strength continues, we might see the market push lower. If the dollar strength reverses to weakness, then of course the market may go higher. So the level we're kind of keying off here is that kind of 3,900 level. Can we stay above it? That was very close to the level we saw on November 17th. So again, if this all is kind of hinging on what the dollar is about to do, and again, if the dollar strengthens, one of the areas that we talked, sectors I talked about last week as being an area expected to underperform. I talked about during my sessions last week to take profits in energy, as we may see energy stocks go down while the broader market even rises. And you'll see today we're down 3% in XLE. And one of the stocks I highlighted in my Friday session was VLO as downside opportunity as the crack spread, the difference between gasoline and oil, begins to reverse. The data side, showed that we saw inventory builds in distillates and refined products generally, despite the fact we had a rather significant draw in crude oil. That didn't exactly cause crude oil to move significantly higher, despite the draws, as we were seeing the products of oil become, inventories continue to increase 2 to 3 million barrels per week. So as a result, oil's taking a breather today with the stronger dollar. And of course, oil stocks are feeling it disproportionately, and in particular, refining. Natural gas, disappointingly so, I thought this is one area that could hold up, has seen some significant weakness over the last couple of days. Although, some kind of a lottery ticket stocking stuff for traded shares. Hey, what if you did a 30, 34 up here? Originally back here when I suggested it cost 20 cents, 25 cents for January. And now all of a sudden you see we're kind of breaking support here. Could we see that cold winter? Could we see demand for natural gas increase? If we look at the product depth here, you'll notice this is what the curve normally looks like, this kind of S curve, we're seeing we're in backwardation. So there is an implied shortage of natural gas. We're just not seeing it reflected right now in the price, as natural gas took a major hit today, down about 10%. Again, I think the stronger dollar is generally contributing to some of the weakness you're seeing. And so you'd really have to look at the areas that are down more than gold is down. So financials, cyclicals, and energy. Cyclicals, of course, that sector that is the highest, has the most highest beta, and technology too. The two sectors that have the highest beta names as part of the S&P 500 over the last year, as represented by the ETF SPHB, which was down 2.4% today. So we're definitely seeing right now, with the stronger dollar today, a bit of a risk off. Now, what this means is the market could sag a little bit over the next week or so with the stronger dollar. We hopefully stay above 390 going into the end of the year, and then we may see a Santa Claus rally between Christmas and New Year's, just off an oversold level if the dollar strength abates. Obviously, the biggest wrinkle in all this is, what is the Fed going to do with interest rates? And so this week, you'll see, for example, today, we had ISM services that came out better than expected in expansion. Factory orders up 1%, better than expected. But coming up towards the end of the week, we have PPI, final demand, coming up here. So again, we have the Fed announcement next week on December 14th. There are data points that could definitely move the market. And so we'll see what happens between now and then. Obviously, we're going to read into stronger data being stronger for the dollar, likely, and weaker markets if that continues up until the Fed announcement. And so keep an eye on that. Keep an eye on what the expectations are for the Fed funds futures. We're now pricing in about an 80% chance of a 50 basis point increase from 3.75 to 4.25. What begins to happen here in the out months? You notice here we actually ticked up a little bit higher, that we're going to have another 50 basis point increase from 4.25 to 4.75 in the February meeting. So this is what's causing the weakness, the dollar strength, is the idea that the Fed may push early to 5%, and then that may carry them above. Let's just look at May here. May carry it above 5%. And you'll see right here that this was a bit lower right here last week, a day ago, for example. And so now all of a sudden we're starting to price in a chance of going north of 4.25 to 5%, 4.75 to 5%, and pushing into 5.25. So we keep seeing these shifting sands. A lot of focus next week on Powell and the FOMC policy statement. Now, obviously, with what's happening today, despite the higher Treasury yields, modestly higher on TNX, there was significant weakness in XLF. The fact of the matter is, if the Fed is going to raise north of 5%, and we're looking at a 10-year Treasury yield that's about 3.6%, what's going to happen is this is going to further invert the yield curve and making it more difficult for banks, particularly lending institutions, to make money off loans. So you can see that XLF was down 2.48% today, but regional banks, these are banks that are more focused on lending, was down 5%. On ACRE specifically, there was some unusual option activity. This was just a roll all within January. But if I bring up my implied volatile open interest here, what you'll see is that we had this kind of lower strike here at 50 and higher strike at 60. So a 10-point spread being moved lower to the 57. Being moved up to the 62. 57, but now constrained from 10 points to 5 points. And if we look at the cost here, you'll see that as you look at the difference here, about $1.10, this costs about $1.30, $1.40, we'll round off here. But the idea is they kept the cost about the same, a little bit of a debit. I would argue that 62 is bought as part of the spread. But what it does do is open up the idea that we may retest our lows by when? By January. Does that seem unreasonable? No. And so we're seeing right now is a very big breakout in financials. We're seeing a breakdown in energy. It's hard for the market to have any footing if those areas are seeing or exhibiting a lot of weakness, financials and energy specifically. So that may lead to short-term weakness. But again, we're looking at 57 by January. there's still the opportunity. I mean, you might wait to see, do we pop back up to 62? Very reasonable possibility. And you could look at one of these downside spreads, whether for 62, maybe you go 60, 57, but you'll see the skew is favorable for buying here and selling there, or buying there and selling there, because the volatility is rising as you go out of the money. The put side providing some edge, but with a target by January about 57. And again, you could look for that rebound just to help kind of set that up further. But the feeling or the bearishness in kind of the financial space generally was felt in other issues. For example, Blackstone. Blackstone's come down, back down at support again at about $82. But Blackstone, there's a couple of bigger trades today. And if we go to the option time and sales in here, you'll see a downside put spread, buying the 70, selling the 60. That's for 20 January. A February, actually, what am I, look at my, my notes here for BX. Yeah. So the February 70, I mean, there was some bought and sold in here, and there's a bunch of stuff in Trade Flash. If you follow this, you'll see this kind of stuff in here. 17 Feb 70 put, 7,500 contracts bought in one print. That's that right there. Maybe some of that was sold towards the end of the day. We'll see how much of that open interest is carried over. But again, what you're seeing is some downside activity targeting relatively low levels, $70, down to 60. So, and this is for January and February's expiration. So while we may see some calmer waters going into the end of the year, we could break out in some of these names, but there is some expectation next year, January, February, we could see even more downside in financials. And that does make sense. Even if the Fed pulls back, the fact of the matter is the damage is done in terms of the economy. We may see ticks up or ticks down in the data, but the bigger picture is the Fed is not going to be able to, or incapable of engineering a Goldilocks scenario or soft landing in this sort of climate. I mean, prices are still probably fairly high compared to where they should be. And so this is going to take an adjustment. The bet is we'll probably see that more next year rather than this year. Another one, Morgan Stanley. Morgan Stanley was a bit of a disappointment on their earnings. However, they were able to engineer a rally with the broader markets. We're back up to the same high we found in August, the same high we found in March. And you're seeing we're breaking down today about 2.5%. There's this kind of floor of support here in that 89 to 87.5 range. But if we start to break and start to top here, we could readily find ourselves back at 75 again. And today the trade was in February, and it was an $80 strike down here, 5,700 contracts, mostly bought at the 80 strike. And so again, that gives you about $10 of downside to 80. And if we certainly overshoot to 75, that would not be unreasonable. And that's by February, for example. The great thing about this, even in February, look at the volatility, rising volatility as you go out of the money. You could buy this and sell that. It might cost you about $1, 25, 35, but that's a what? That's a 5-point spread. And the delta on that option down here is about a 21 at 80. So a decent probability of touching 80 even below. And again, the idea is that those kinds of spreads are outlier. They're kind of out there a little bit. Reasonable chance of touching 85. And again, your break even's about $1.30 below that. So it doesn't take a lot of movement just to break even, but the upside's there if we retest 75. So if you're trying to build some of these bearish positions out of the money, kind of lottery ticket, meaning that the probabilities are low, but the reward to risk is very favorable. So anyway, a number of different financial, we could throw REITs in there as well. ACRE is a commercial real estate. And if we go here to the trade tab, you'll see real estate company. So again, commercial real estate tied to not necessarily REIT, but real estate specifically, down 4.5% today at support, potentially forming a 1, 2, 3 triple top formation. If we close below this level here, volume was a little higher than normal. The target's going to be $10 down here, but ACRE, of course, you're looking out in February. It was the $10 strike price again, 26,000 contracts. This product does not trade a lot. 888 times the average, most of it between the market. I don't believe there's anything in Trade Flash here, but the idea being is that this is significant. 19,001 print. You'll see a bunch of other buys in here as well. I would argue that is a buy as well at 35 cents. But again, we're looking at what? $10. And that seems like a reasonable target here for ACRE. And you might spill this over to other REITs or even, mortgage mortgage REITs as well, like in AGNC or NLY. You could spill this over in Home Builder as well. All of these are testing high levels. And just look at the prospect of it touching its lows from June and for October by January and February. And again, what are we pointing at? We're pointing to the fact that, yes, we may see a bit of a bumpy end of year. Are we going to sell off wholesale? Probably not. Are we going to see some sort of major risk off event? Possibly, but probably not likely. But January and February does bring in the possibility of much lower prices. The wrinkle in all this is, what does the Fed do? Of course, the stronger dollar, banking on the Fed, being more hawkish next week, did contribute for some of the selling today. As you look at the VIX didn't move a whole lot. We've seen this show before. We're just kind of shuffling the chairs on the Titanic just a little bit. So VIX, not a lot of mobility despite the 0.5% decline, or shall we say 1.8% decline. But we know most of that was precipitated by the stronger dollar. And so not as much of a loss of value as you might expect. We want to see what's going on with SKU, though. I mean, SKU today, or SKU on Friday, was around 118. Does it tick higher or lower? I was pricing some stuff out earlier. It's not there anymore. It doesn't look like SKU is going to really rise here. We may even see SKU fall a bit as well. So we want to see SKU start to build towards the 130 mark. We have seen, or did see on Friday, back month volatility reach that 20% value, meaning what? If I look at VIX 3M plus VIX ratio, this did cross above the 1.2. The VIX futures have already been pricing in over 20% premium to the 30-day VIX. But this gives you a countdown, maybe 3 to 4 weeks here. You might see a 5 to 10% correction, which puts you into what? 2023 at this stage. So again, I'm not expecting to see a major sell-off before the end of the year. But again, depending on the Fed, we may see the market mull around here. And maybe if they're dovish next week, or they start to give the market a little bit they want, maybe we do get that rally the last week or two going into the end of the year. But prepare for 2023. This is where things could get ugly as data starts to turn more negative. The labor market becomes softer, increasingly more soft, and we start to see the downgrades in earnings and earnings misses hitting as we start to get the data from the holiday season. So there's a lot of uncertainty out there. I'm laying that out, but there is some elements of opportunity. Coal right now is an area I'm watching. Today it's down 6%, BTU specifically, but CEIX, we ran through some potential targets here on a bounce, 86 on CEIX, or more of a diversified miner like Tech that also mines coal. We're looking at 40, 21, maybe 46 if we break the 38 level. Well, we didn't break out today. We actually broke down. But what you did see is that the volumes, well, look, I mean, it's about average today on Tech. You look at BTU, it was actually slightly below average today with the bigger sell-off. However, what you did see is option traders come in and roll. And what does that mean? You took an option that was in the money here at 29, closing out 4,000 contracts. You're rolling it out to the look at the wrong line here. Rolling out 30 December. So I'm looking at my page here. Rolling it out to the 30 December, rolling it out of the money, taking some money out of the trade, but still holding it out there at 32, which is your prior high. So this is one to watch. Do we break 32? Maybe even break the midpoint of today's larger candle body. This might give an indication, hey, we're finding that strength or bounce. You're definitely going to need some confirmation or like a trigger or some sort that says, okay, now's the time. Maybe that trigger is around 31 or the high at 32 before you really strongly look at this. But the prospect is what? I mean, the prospect is just taking this last swing here, taking a 138.2, that gets you about $36. So if we do have a colder winter, if we do start to see more demand for coal, particularly from China, you see news of drought conditions, hydroelectric power being an issue. They've been increasing their coal-fired power plants, the numbers of them. So we might see, again, a little bit of an uptick in demand. I was encouraged to see last week's strength, but then to see today's follow-up trade rolling the call, keeping that risk on the table in lieu of a bounce here over the next couple weeks going into the end of the year. Well, folks, I got to run. This is the end of today's video. I'll catch you back next week on the TheoTrade video. You have a great one. We'll see you then. Thank you.